Nancy from Nancy Chu Homes at Keller Williams and J Metro Group. Do you guys know what easy money is? Easy money or easy monetary policy is essentially when the Fed allows there to be a cash buildup within the banking system. So they lower interest rates and they make it easier for banks to loan money. Easy money is basically a representation of how the Fed can stimulate the economy using easy monetary policy. They lower unemployment. Now, unfortunately, there is one major side effect of that, and that major side effect is inflation. Okay, we're going to come back to this. So you guys, we have seen 3 days in a row of the decline. This is May 10th, by the way. We have seen 3 days in a row of decline of the stock market. A 7% drop in the S&P, a 10% drop of NASDAQ. Okay, so the Fed, in order to fight inflation now, has to they have to do it through rate policies. And the way they do that is they try to take cash out of the financial system, out of the economy by raising interest rates. Okay? So that cash that's there isn't used to chase fewer goods and services, all right, which results in inflation. Now, don't forget, the market has gotten used to the idea of easy monetary policy, the idea that we can flood the economy with money and everything's going to be fine. It doesn't really know how to react to these higher interest rates, okay? Don't forget, we have had 12 years of administrations that have been okay with easy monetary policy, just dumping massive amounts of cash into the system, right? Now, don't forget, when we raise interest rates, it's not just to temper the prices of goods and services and housing, but it also affects what the stocks should be valued at. Okay? So in other words, it's being used to temper the idea of higher risky returns from U.S. government bonds, for instance. Okay? Now, putting all this aside, thinking about this, the Fed basically says that persistent inflation is much worse, is a much bigger evil, and they have to fight it. And that's what we're trying to do now, okay? Everybody agrees, politics aside, everybody agrees this is the right thing to do for our economy. Now, do I normally think that I would tell you that this situation is exacerbated, probably significantly by things like the war in the Ukraine, oil prices. China has been having these, significant COVID shutdowns, and they're shutting down areas of, manufacturing. So we're seeing supply chain slowdowns in the production of goods that we usually use in this country. Their ports are all snarled right now. It's a hot mess, okay? So, yeah, here's where we're at. How does this affect real estate? During periods of stock market volatility, we often see investors move their money over to real estate. Why? Because it's a hard asset. It can produce income. It's shelter, for goodness sake. It's one of our basic needs. And over time, it holds its value and always appreciates through long-term growth. You got to hold it through a cycle, guys. You got to hold it for 10 plus years to treat it as an investment. Now, what does a 10 to 15% stock market dip? What does that do? Well, the trade-off is a couple of extra points of real estate growth, because people will take their money out of the stock market and move it into hard assets like housing. So don't expect the real estate business to stop anytime soon, okay? So while we may see a slightly longer day on market or maybe a few less offers, shelter is still a really good bet. And unless and until we see a significant dip in, the stock market, like upwards of 25, 30%, real estate is going to stay very stable because people have decided that what's a good investment? Shelter. All right, guys, I'll talk to you guys next week.